think we've set the bar pretty low, so we're on track to underpromise and overdeliver. But keep in mind, average earnings growth is 6.25% over a long-term period, and we're expecting negative 2.6% growth. Yet the market has taken off this year and really shows no signs of stopping. So again, I think the market is going to punish negatives more than it's going to reward positives. If we surprise on the upside on earnings, I think the market will be okay with that, but it's not going to drive any more rallies. I think the Fed is what's driving that.
And just to be clear, I mean, even if we get any negative growth rate on earnings, that'll be the second quarter in a row. That's a technical earnings recession. Amazing to see stocks run up like this into that kind of environment.
And the stocks that are going to be put in the penalty box, I think, will take a couple of quarters to come out. And the ones that make earnings will be, again, the flight to safety. Exactly what you're seeing. Let's stick with the large cap liquid Microsofts, Amazons of the world. And I think the opportunity as an investor, as a long-term investor for us, is any of these big caps or any of the liquid names that come down, here's an opportunity to buy them, especially if it's a 1 or 2 quarter short-term issue.
You've been topping up your Microsoft?
Microsoft's one of our largest holdings. We've been trimming it back a little bit because it's just getting a little bit too big. But again, it's one of the highest quality cash flow companies out there that really has a long-term trajectory.
Guys, one thing that perked up today, which was notable, were the transports. I mean, we've been talking about day after day, the market's hitting new record highs and the transports have lagged, and that's maybe some sort of ominous signal. They rose 2% today, and we're actually a leader. What does that tell you, Liz?
Well, the goal of monetary policy and the goal that Jerome Powell continues to state is that he wants the economy to keep moving along at this pace, and he'll do what he needs to make sure that we continue expanding.
So this is the market backing him up.
This is the market saying,
you want to extend this expansion? That's how we're going to price it.
This is a classic expansion signal, right? So if he continues to say we're going to support an expansion, here are the things that are economically sensitive that would indicate that expansion can keep going.
What about this, the banks? Because if we do get a rate cut, that itself, of course, is not going to help the banks. But this week we have seen a bit of a steepening of the curve. The long end's risen. Might it be not as bad as people expect?
So I've been pretty constructive on financials for a while. I started to sound insane after a little while, but I still think that they're high-quality companies, especially in the U.S., and they're a good place to be if we're not heading into a recession. Now, it's obviously clear that if their interest margins are going to get hurt if the curve doesn't steepen any further, but they still can hold up as long as the economy is healthy.
What should we watch in the bank earnings besides net interest margin? Everyone expects to be weak, right?
Yeah, net interest margin and net interest income might suffer a bit, but loan growth could offset that a little bit. And I do think, to Liz's point, there's fee income as well. It's going to be good on the IPO side, probably bad on the trading side. But it'll all come down to their guidance. I mean, the big point I'd say on the banks either way is the last 2 quarters, they've had an easy setup. They've beaten earnings. It hasn't really proven to be a catalyst for the stock prices. So you can say we might get that again, but will the stock prices react?
You have to remember that the appetite for treasuries is going to stay there, because what are investors' other options? You can buy German bunds, you can buy gilts, you can buy Japanese bonds. Nobody wants any of those, right? So the appetite for treasuries, even at a 2% 10-year, is going to continue to be healthy. So the curve probably isn't going to steepen in a meaningful.
The other thing to look at the banks, if you saw in the last 2 weeks, they've all raised their dividends. So now when you look at whether you want a 2% treasury or you want a company that's raising the dividends, a good balance sheet, cheap valuations, and one other thing I would look at is asset management fees. Because given where we are in the S&P, you're up 20%. That comp is going to start looking a lot better. Remember what happened in the 4th quarter. So that could provide some support, especially if net interest margins going the other way.
I would think also mortgage refinancing would be helpful. We've seen this sort of spurt of activity.
That would be helpful, but you got to watch credit. I think people are going to be focused on, are we in the 7th, 8th inning of credit, and are loans improving, and what quality of those loans are we delivering?